Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to go through the EIA data, just looking at it in our normal breakdown in terms of overview, refined products, and then looking at exports and a little bit on OPEC and what's happening with some updates in China and India in terms of oil demand as well as refined product demand. So just to kind of kick it off and really get into it, when we look at crude stock draws, which was a bit of a surprise versus API, but really kind of expected when we looked at what Cushing was going to do and how we had a little bit of a draw there. It's something to consider as we go forward and try to understand, okay, well, where are the shifts going to come? How are they going to really arise as we go through what should normally be a draw period? So just digging into the numbers a little bit, when we look at crude oil, we're down on a commercial level about 750,000 barrels. Once we factor in the SPR, the Strategic Petroleum Reserve, we're down 870,000 barrels. So again, that's starting to slow. The bigger issue is where the builds and draws were really happening. So when we look at the Midwest had a nice draw of about 1.9 million. But the Gulf built. There was a build of about 2 million, and that's really as the Gulf of Mexico production picks back up and normalizes. You can see that the production is back to 11 million, which is just, again, that 100,000 is just looking at Gulf of Mexico coming back. So there's really not too much to say one way or the other. We expect to see a little bit more, slower draws, just as production continues to stay fairly stable in the U.S. Imports continue to rise. Exports will be fairly stable to slightly down, and we'll go through that in segment 3. But the other big issue is going to be how quickly do we get to that 80%, which is our target for refinery throughput, and we'll go through where we sit right now. And before we go on, again, we'd like to remind you, please like, share, subscribe. Your support is always appreciated. So just digging into where things are, this is kind of what we've been talking about when we look at total inventories. Again, this is including SPR. You can see the pace is just not there. Like, we're just flatlining to the right, where we should start. We really want to see these draws starting to accelerate, and we're just flatlining, just given the amount of imports that remain fairly stable, given at near record lows, but production remains at about 11 million barrels. We're a little bit lower, but again, it's going to come down to what do things look like into 2021, and we're expecting an exit rate of about 10.5 to 10.7 million barrels, and it's something that we're going to go through as when we film today, because we get the rig count today, yay! So that means that we get to help put together our frac spread show. So that's going to be something where we're going to talk a little bit more about production overall. And now when we look at Cushing, typically Cushing draws right now. And I think it's important to understand how the adjustments happen, because technically it's at a seasonally adjusted all-time high. Again, that doesn't really matter. It's really as we go to, okay, well, where are we in regards to the quote-unquote tank tops? Where are we in storage? Is this going to continue to grow? And we did get some spreads open up, which pulled some crude out of Cushing into the Gulf of Mexico, which is a positive. But again, our production remains elevated, which is just going to continue to push back and push crude into Cushing. So as much as this has kind of sits here, it's not something where we think we're going to move back to the all-time highs as we go into December, but we're just going to go sideways and we're going to start to drift higher. Again, the slope is going to matter most. As we saw in March into April, the slope, it just went parabolic. Here, it was been a more gradual, slow move as the hurricanes really kind of adjusted where production was in Pad 3. This is going to be something to watch as we go forward, because it could continue to, it could weigh on pricing, specifically Cushing pricing. Here's where we look at just oil commercial inventories. Again, we're right at the top of the cloud. Really, it's the pace that continues to slow down. We're not getting back to, within that at least in the cloud. So again, these are things that are going to continue to weigh, and the pressure is going to remain, because we can't send crude into Europe, or at least we're not sending as much into Europe. We are sending more into South Korea and China, but the question is going to be how do we kind of right this ship given where things sit? And we do have a little bit more imports coming in over the next couple of weeks. And when we talk about imports, we have to look about PADD 3, and when we look at inventories in the Gulf of Mexico, you can see that they're really starting to rise, and again moving back up into a trajectory that we really don't want to see, given where the backdrop is and how we can really kind of right this glut. And it's not going to come from refinery utilizations, because that's really going to be capped. It's going to have to come from either less production and or more exports. And we're really seeing pressure on both sides, where production remains fairly stable and or flat. Even this is also including, mind you, the about 5 named hurricanes that have impacted production. And yet we're still here, which I think points to some of the issues that OPEC is really trying to weigh as they consider, do they extend the cuts? Do they cut more? And so far, the commentary is that they're just going to extend the cuts for another quarter, and maintain the levels of production that they have right now, which we'll go through in more detail in segment 3. And here's where we start going again into those imports. So the PADD 1 had a big spike. It's always going to fluctuate. There was a decent amount of oil sitting offshore. There were some first-time cargoes that we haven't seen since 2017 or whatnot. But again, it's just going to come down to trying to find the right pricing to attract some of that oil. The rest has been, fairly stable. The PADD 5 will, based on what we're seeing, is going to see a little bit of an increase, but they've had a significant amount of congestion at those different ports, which is something that we're actually going to talk about in the Econ show. And PADD 3 is one where we see additional VLCCs flagging the U.S., and that's where they're going to come in. Again, that's just going to be timing, but we will see an increase in imports, which should marry with the increase in activity coming into PADD 3 refiners. Now, PADD 2 is one where, when we look at it on a year-over-year and a 5-year average, you can see that we're seeing those imports remain elevated, which we've been talking about as we look to Canada and as we look to other ways of managing total flow. And that's one to watch, because PADD 2 is where we think we're going to continue to see an additional amount of imports, not just PADD 3, but really PADD 2. PADD 1 will normalize. That's just one that had a nice spike. But PADD 2, PADD 3, and PADD 5, we think we'll see an acceleration. This week is going to be tough, obviously being Thanksgiving. You try to front load. So we did see an increase in the beginning of the week, and then that usually slows down and then picks back up. So it's just going to be a matter of timing as to when that gets realized. Now, when we look at utilization rates, obviously things get pulled forward. They were up about 1.3%, which is oil runs of about 422,000 barrels a day. Again, our target is about 80% utilization rate, and as we've been saying, we expect essentially the lion's share to come from PADD 3. We were pretty close. We said that we were going to see about a 350,000 barrel a day increase in Gulf of Mexico. We're at 347, so yay! It's always just a matter of timing. That's one that we think we'll continue to get to a bit more of a normalized level, especially with the amount of yield that's actually increasing and is going into diesel, because previously we had gasoline yields fairly stable and we had diesel yields going very low, or distillate yields going very low. That's starting to normalize a bit with gasoline coming down and now a bigger focus on the diesel cut. The problem is when you make distillate and then into diesel, you inherently make gasoline. So that's why we have to watch where gasoline storage is going as we see an increase in yield in distillate. But again, this is something that is good. It's pulling more oil into the system. But now as you pull more oil into the system, you have to say, okay, well, where is it going to go? Is there demand for it internally, externally, and how is that going to kind of balance, especially with margins remaining under pressure on a global level? So implied demand pared back, which is what we were saying. Gasoline had a small decline. It's one where shockingly Thanksgiving is a big driving season. Again, we think it'll disappoint in terms of where we have been in years past, but obviously it's going to be an increase week over week, and it's going to be a matter of normalizing. And we'll go through some of the intricacies of those numbers in segment 2. And now when we look at distillate, as we go through distillate, that's something where we think it'll continue to slow down on a gradual level. And then as we go into jet fuel, again, increase in pull through. Airlines, airports like to prepare ahead of time to make sure that they can get in and have the jet fuel available, because there is going to be an increase this week, as we'll talk about and as we've seen. It's just it'll be muted in terms of the carry through, which is why jet fuel will increase, and as we said, lower highs and then lower lows as we go through the remainder of the year. Propane, propylene, again, demand is gonna waffle, but you can see just based on year over year and 5 year, it remains strong, and there's nothing to say that that's going to stop, just given the usage that we continue to see in the export demand in the global market. Now, when we look at floating storage, as we said last week, we expected it to increase just as more of these ships, arrived, and they started to pare back, especially as refiners are preparing to run to increase to about that 80%, really driven by that PADD 3. They're going to need imported oil. Again, still at the bottom of the cloud. There's nothing to say we move higher than that. Just going to go sideways at this point, and it's just going to be those timing delays over the next couple weeks. Now, again, the imports, same thing. It's going to remain at the bottom of the cloud, but it's something that will shift higher, and it's going to just, again, marry with the increases. It's just going to be those timing issues. But again, these are things that we expect to see increase over the next couple weeks. Now, by saying that, we're not reinventing the wheel. As you can see, the bottom of the cloud moves higher because we normally see an increase in imports. We normally see an increase in floating storage, just as that timing delay is needed, and you need that buffer for some of these PADD 3 refiners to increase. The problem is we're getting renewed announcements that we're either going to have refiners staying down and or not ramping up. It's just, so that's why we think that as we approach that 80%, as we get into the end of the month, we're not going to see too much past that, just because the demand isn't there. The margins remain depressed, and we still have a overabundance of refined products, which is, again, looking into, when we talk about PADD 2, we're still tracking just above that 5 year average. So not only is PADD 3 seeing those increases, but also PADD 2. So we have to look at this, which, again, it typically moves higher on a seasonal average. We just think this is going to remain above that seasonal norm, but again, just track within the normal range, just above that 5 year, just as more of that oil comes down, and it's just needed over the next few months. Now, when we look at refinery utilization rates, again, just coming back into the bottom of the cloud, 80% is where we've kind of calculated where we'll be as we head into December 1st, and then as we get into the end of the year. Now, it'll come down to timing, because again, we do have Thanksgiving. You could see some shortfalls this week as some guys pare back as individuals go on vacation, or they run a certain amount of skeleton crews. So there's just not as much activity. Again, that's just going to be timing. It could be maybe 1%, but again, nothing really meaningful to the downside, as refiners are already operating at near skeleton crews and reduced rates. There's really, you don't need to adjust the same way we normally do on a holiday week. So that's why we think that we'll maintain some of this going through, especially as that demand continues to waffle and they look to increase production of distillate, which again is going to require a different type of feedstock. And we'll start to go through some of those feedstock, the unique natures of feedstock as we go into not only just segment 2, but also segment 3.